Before we begin, it's crucial to understand that the information provided in this video is for educational and informational purposes only. I am not a financial advisor, attorney, or real estate professional, and this presentation is not intended as financial, legal, or investment advice. The process of buying a home and securing financing is complex and highly individualized. You should always consult with qualified, licensed professionals before making any financial decisions. You are about to make the single biggest financial decision of your entire life, and you're probably using the wrong words to describe it. And that tiny mistake, that simple slip of the tongue, is a symptom of a much larger, more expensive misunderstanding that could cost you tens of thousands of dollars, or even your home. Think about it. You've spent months, maybe years, scrolling through Zillow fantasizing. You've saved every penny for a down payment, picturing your future life within those four walls. You finally find it, the one, the perfect house. Your heart is pounding. Now comes the serious part, getting the money. So you walk into a bank, or more likely, you fill out an online form and you ask for a what? A mortgage? Or a home loan? Most people, probably you included, use those terms interchangeably. Your real estate agent does. Your loan officer does. The internet does. It's all just part of the soup of confusing jargon you have to swallow to get the keys to your dream house. It seems harmless, right? Just semantics. But what if I told you that not knowing the fundamental difference between a home loan and a mortgage is like a surgeon not knowing the difference between a scalpel and a suture? They are two distinct, critically important tools used for very different purposes in the same operation. And if you don't understand what each one does, you are walking into that financial operating room completely vulnerable. This isn't just about sounding smart at a dinner party. This is about understanding the power dynamic between you and the institution lending you hundreds of thousands of dollars. One of these terms represents the money you're borrowing, the dream. The other represents the bank's legal collateral, their security, their power over you and your property if things go wrong. It's the teeth of the agreement. And by the end of this presentation, you will not only understand the difference, you will be able to navigate the entire home buying process with a level of confidence and clarity that 99% of buyers simply do not have. We are going to demystify the jargon, pull back the curtain on the industry's convenient shortcuts, and empower you to protect your single biggest asset. So let's get this straight right now. A home loan and a mortgage are not the same thing. They are two separate legal concepts and often two separate legal documents that you will sign at closing. Let's start with the exciting part first. The part that gets you the house. That is the home loan. A home loan is, at its core, a type of loan used to purchase a property. Simple enough. But let's go deeper. The home loan is formally documented in a contract called a promissory note. The name itself tells you everything you need to know. I promise to pay. When you sign that promissory note, you are making a formal, legally binding promise to a lender. You are saying, I, the borrower, promise to pay you, the lender, back this specific amount of money, over this specific period of time, at this specific interest rate. The promissory note is your IOU. It's your personal commitment. It outlines all the terms of the deal. The total amount you're borrowing, which we call the principal. It details the interest rate. Is it fixed for 30 years? Or is it an adjustable rate that could change later on? It lays out your monthly payment schedule, breaking down how much goes to principal and how much goes to interest. It also specifies the penalties for not paying on time, the late fees. Think of the promissory note, the document that solidifies your home loan, as a standalone personal debt. If you borrowed $50,000 from a rich uncle to start a business and signed a detailed IOU, that's essentially a promissory note. You have a personal obligation to pay him back. If you fail, he can sue you personally for the money you owe him. The debt is attached to you. This is a critical point to understand. The home loan, as defined by the promissory note, creates the debt. It's the engine of the whole transaction. Without the loan, you don't get the money. Without the promissory note, there's no official record of that debt or its terms. So when you go through the pre-approval process, when you're shopping for rates, when you're comparing offers from different lenders, what you are actually shopping for is a home loan. You're looking for the best possible terms on your promissory note. You're trying to secure the lowest interest rate, the most favorable repayment schedule, and the most manageable monthly payment. All of that is the home loan. It has nothing to do with the house itself, not really. It's a financial agreement between you and a lender. You could theoretically have a home loan without it being attached to a house, though that never happens in practice for one very important reason, which brings us to the other side of the coin. The lender, the bank, is not your rich uncle. They are not going to hand over $3, $4, $500,000 based on a pinky promise and a signed IOU. They are a business and they need to manage risk. What's their biggest risk? You. Specifically, you not paying them back. If you default on your personal loan from your uncle, his only recourse is to take you to court. It's a messy, expensive, and time-consuming process to try and get his money back from your other assets or future wages. A bank lending out billions of dollars cannot operate that way. They need a much stronger, much more direct form of security. They need a guarantee. They need to attach that debt, your home loan, directly to a massive, valuable physical asset. An asset they can take and sell to get their money back if you stop paying. And that, right there, is the entire purpose of the mortgage. It's a legal document, a contract you sign, that essentially forges a chain between the money you borrowed and the house you bought. It gives the lender a security interest, a legal claim on your property. In legal terms, this is called a lien. Think of a lien as a legal flag planted on your property's title record. It's a public notice to the entire world that says, hey, this property has a debt attached to it. Before it can be sold freely, this lender has to be paid back first. It's the bank's way of calling dibs. So, when you go to closing, you're not just signing one giant document. You're actually signing two separate, critically important papers that work together like a lock and a key. Understanding these two documents is the absolute core of understanding the difference between a home loan and a mortgage. The first document is called the promissory note. This is your home loan. This is the IOU. It's the promise part of promissory. It is, in no uncertain terms, a legally binding contract where you promise to pay back the borrowed money. If the home loan is the river of debt, the promissory note is the document that charts its course, its speed, and its final destination. It contains all the juicy details of your loan, the total amount you borrowed, which is called the principal, the interest rate, the price you're paying to borrow that money, the term of the loan, whether it's 30 years or 15 years, the exact amount of your monthly principal and interest payment, the due date for that payment every month, and of course the penalties for being late. It's the rulebook for your debt. But here's something about the promissory note that almost no one tells you at the closing table, and it is a game changer for understanding how the American mortgage system works. The promissory note is what's called a negotiable instrument. That sounds like boring legal jargon, but I want you to think about it like a rare, valuable baseball card. Once you sign it, the bank holding it can sell it. They can trade it. They can bundle it with thousands of other baseball cards and sell them as a package to big investors on Wall Street. Have you ever gotten a letter in the mail, maybe a year after buying your house, that says, your loan has been transferred, and you now need to make your payments to a new company you've never heard of? This is why. Your original lender didn't sell your house. They sold your debt. They sold your promissory note. The new company bought the right to collect your monthly payments. Your promise to pay is an asset, a product that gets bought and sold on a massive multi-trillion-dollar market. But no matter who owns your promissory note, the terms you agreed to, your interest rate, your monthly payment, they don't change. The new owner has to honor the original contract. They've simply bought your stream of payments. So, the promissory note is your personal promise to pay. It's the evidence of the debt. But by itself, it's still just a promise. If you stopped paying, the owner of your note could sue you for the money, sure, but that's a long, expensive process. It doesn't give them an automatic right to your house. For that, they need the second document. The second document is the mortgage. This is the enforcer. This is the security. If the promissory note is the IOU, the mortgage is the collateral. It's the document that links your promise to pay directly to the physical property. It's what says, if I break the promise I made in the promissory note, the lender has the right to force the sale of my house to get their money back. This process has a name we all know and fear: foreclosure. The mortgage document is what gives the lender the legal right to foreclose. It secures the note. That's why it's called a security instrument. Now, this is where it gets a little more complex, because in America we have two different ways of doing this depending on what state you live in. You either have a mortgage or you have something called a deed of trust. They accomplish the exact same goal, securing the loan with the property, but they work in slightly different ways. In what we call a mortgage state, there are two parties involved: you, the borrower, who is called the mortgager, and the lender, who is called the mortgagee. It's a direct two-way contract. If you default on the loan, the lender generally has to go to court to get permission to foreclose on the property. This is called a judicial foreclosure. It involves judges and lawsuits, and it can be a relatively slow process. But in a deed of trust state, things are a bit different. There are three parties involved: There's you, the borrower, called the trustor. There's the lender, called the beneficiary. And then there's a new player, a neutral third party called the trustee. When you sign a deed of trust, something fascinating happens from a legal standpoint. You technically transfer a temporary, non-possessor title of your home to this trustee. You still live there, you still own it for all practical purposes. It's your home. But this trustee, often a title company or an attorney, holds onto that sliver of legal title for one reason and one reason only: to act as a referee. If you pay off your loan as agreed, the trustee's job is simple. They release the title back to you, the chain is broken, and you own the home free and clear. Congratulations! But if you default, the lender doesn't have to go to court. They just notify the trustee. The deed of trust you signed at closing already contains something called a power of sale clause. This clause gives the trustee the pre-authorized permission to sell your property if the lender proves you've defaulted. This is called a non-judicial foreclosure. It's faster, cheaper, and much more efficient for the lender. This is why many lenders prefer the deed of trust system. So, which one do you have? States like Florida and New York are primarily mortgage states. States like California, Texas, and Virginia are primarily deed of trust states. It's a patchwork across the country, but the end result is the same. The document, whether it's a mortgage or a deed of trust, is the bank's ultimate insurance policy. It's the legal mechanism that makes your home the collateral for the loan. Let's put it all together. The home loan is the abstract concept of the money you owe. The promissory note is the physical, legal evidence of that debt. Your personal IOU that details all the terms and can be bought and sold. The mortgage or deed of trust is the separate legal instrument that attaches that IOU to your house, giving the lender the right to seize the property if you fail to pay. You cannot get a standard home loan without a mortgage. And a mortgage is meaningless without a home loan to secure. They are a package deal. One is the debt, the other is the security for that debt. One is the promise, the other is the consequence. When you sit at that closing table, a mountain of paper in front of you, these are the two titans you're dealing with. You sign the promissory note, creating the debt. Then you sign the mortgage or deed of trust, chaining that debt to the most valuable thing you own. In that moment, by signing those two documents, you set your financial life on one of two very distinct paths. One path leads to building equity, creating wealth, and eventually owning a piece of the American dream free and clear. The other path can lead to late fees, damaged credit, and the devastating process of foreclosure. What determines which path you end up on? It's not just about making your payments on time. It's about understanding the very engine of your debt, the single most powerful number written on that promissory note. A number that can be fixed or can change, a number that dictates how much you will truly pay for your home over the next 30 years. That number, of course, is your interest rate. And how it works is far more fascinating and far more critical than you might think. Just how critical? Let's imagine two neighbors, Sarah and Tom. Both are buying identical houses for $400,000. Both put down 20%, so they're each taking out a loan for $320,000 over 30 years. They are, for all intents and purposes, in the exact same financial boat. Except for one tiny detail. Sarah, through diligent shopping and a slightly better credit profile, secures an interest rate of 6%. Tom, in a bit of a rush, accepts the first offer he gets at 7%. Only 1 percentage point difference. It sounds trivial, doesn't it? A single point. But that 1 point is a financial earthquake. Over the life of her loan, Sarah will pay about $292,000 in interest. Tom, on the other hand, will pay over $363,000 in interest. That's a difference of $71,000. $71,000. Enough to buy a luxury car, fund a child's college education, or take a trip around the world. All lost or gained because of a single percentage point. That is the devastating, life-altering power of the interest rate. It is the single most important number in your entire home buying journey. It's not just a fee. It's the price you pay to rent money from the bank. And just like renting an apartment, the price can be fixed for the entire lease, or it can change year to year. This brings us to the first great divide in the world of mortgages: the battle between fixed rate and adjustable rate. The fixed rate mortgage, or FRM, is the bedrock of American homeownership. It's the most common, the most straightforward, and for many, the most comforting option. The concept is beautifully simple. The interest rate you agree to on day 1 is the exact same interest rate you will pay on day 10,957, that's 30 years later. It is locked in, set in stone. If your rate is 6.5%, Your principal and interest payment will be the exact same amount in year 1 as it is in year 29. It doesn't matter if the economy booms, busts, or flies to the moon. Your rate is your rate. This predictability is its superpower. It allows you to budget with absolute certainty for the next 3 decades. You're insulated from the volatile swings of the financial markets. You can sleep at night knowing your largest monthly expense will never, ever surprise you. It's the financial equivalent of a bomb shelter. Safe, secure, and predictable. But then there's the other side of the coin. The more daring, more complex, and potentially more rewarding sibling. The adjustable rate mortgage, or ARM. An ARM plays by a different set of rules. Instead of locking in one rate for 30 years, an ARM offers you a lower introductory teaser rate for an initial period, typically 3, 5, 7, or 10 years. And this is the lure. That initial rate can be significantly lower than what you'd get on a fixed-rate loan at the same time, which means a lower monthly payment to start. It feels like you're getting a fantastic deal. But after that introductory period ends, the adjustable part kicks in. Your interest rate is no longer fixed. It begins to float, adjusting periodically, usually once a year, based on the movements of a specific financial index. Think of the index as the weather. It could be the US Treasury bill rate or another benchmark. It's a measure of the current cost of money out in the wider world. The lender then takes that index and adds their own predetermined number on top of it called the margin. The margin is the bank's profit. It never changes. So, your new rate is the index plus the margin. If the index, the financial weather, goes up, your interest rate goes up, and so does your monthly payment. If the index goes down, your rate and your payment go down. You are now riding the waves of the economy. This is where the risk lies. If you get a 5-to-1 ARM, for example, your rate is fixed for the first 5 years. After that, it adjusts every 1 year. If interest rates across the country have skyrocketed during those first 5 years, you could be facing a sudden and dramatic payment shock. Your monthly housing costs could jump by hundreds, or even over $1,000 overnight. This is the exact scenario that caused so much pain for homeowners during the 2008 financial crisis. People were lured in by low teaser rates, only to be unable to afford their homes when the rates adjusted upwards. To prevent a complete catastrophe, ARMs have safety features called caps. There's a periodic cap, which limits how much the rate can increase in any single adjustment period. And there's a lifetime cap, which sets a ceiling on how high your rate can ever go over the entire life of the loan. These caps are your life vest, but they don't stop you from getting soaked in a storm. An ARM is a bet. It's a bet that you will sell the home or refinance before the introductory period ends. Or it's a bet that interest rates will be lower in the future. It's a strategic tool for sophisticated borrowers, or for people who are certain they won't be in the home long term. For most people, the stability of a fixed-rate mortgage is the far wiser choice. So you understand the two main flavors, fixed and adjustable. But what determines the actual number you're offered in the first place? Why does your friend get offered 6.2% while you're offered 6.9%? It's not random. Lenders are calculating risk, and they use a handful of key metrics to build a profile of you as a borrower. First and most importantly is your credit score. This 3-digit number is your financial report card to the world. It tells lenders how responsibly you've handled debt in the past. A higher score, typically anything above 740, screams low risk. It tells the bank you pay your bills on time, you don't overextend yourself, and you're a reliable bet. In return for that low risk, they reward you with their best interest rates. A lower score suggests a higher risk of default, so the lender charges a higher interest rate to compensate for that increased danger. Second is your down payment. The more money you put down up front, the more skin in the game you have. A lender sees a 20% down payment and knows you are heavily invested in the property's success. You're less likely to walk away if times get tough. This reduces the lender's risk, which in turn can earn you a lower interest rate. A small down payment of 3% or 5% means the lender is shouldering almost all the risk, and they will charge you a premium for it. Third is your debt-to-income ratio, or DTI. This is a simple calculation. What percentage of your gross monthly income is already spoken for by other debt payments, car loans, student loans, credit card bills? If your DTI is too high, say 45% or more, lenders get nervous. It suggests you might be stretched too thin, and that adding a large mortgage payment could push you over the edge. A lower DTI shows you have plenty of financial breathing room, making you a safer, more attractive borrower who qualifies for better rates. Finally, there are the big macroeconomic forces you can't control, primarily the decisions of the Federal Reserve. When the Fed raises its key interest rate to fight inflation, it makes borrowing money more expensive for banks. The banks, in turn, pass that cost on to you in the form of higher mortgage rates. These global and national trends set the baseline, and then your personal financial profile determines where you land within that range. Now, one last crucial distinction that trips up nearly every first-time homebuyer: the difference between the interest rate and the APR. When you get a loan estimate, you will see two percentages, and they will be different. The interest rate is the pure cost of borrowing the money. It's what's used to calculate your monthly principal and interest payment. The APR, or annual percentage rate, is the all-in number. It represents the true cost of your loan over its lifetime because it includes not just the interest rate, but also most of the closing costs and fees associated with getting the loan, things like lender fees, mortgage insurance, and discount points. Think of it this way: the interest rate is the sticker price of the car. The APR is the final, out-the-door price after all the taxes, title, and dealership fees have been added in. The APR will almost always be slightly higher than the interest rate, and it is a more accurate tool for comparing loan offers from different lenders because it gives you a more complete picture of the total cost. Understanding this number, the interest rate in all its forms, is not just about finance. It's about freedom. It's about the $71,000 that separates our two neighbors, Sarah and Tom. It's about knowing how to navigate the system to keep more of your hard-earned money in your pocket and less in the banks. You now know the difference between fixed and adjustable, what factors shape your rate, and how to read the true cost with the APR. But the rate is only one half of the equation. The other half is the loan itself, the vehicle that the rate is attached to. Because not all home loans are created equal. Some are backed by the government, some are designed for veterans, and some are for multi-million-dollar mansions. And the type of loan you choose can be just as impactful as the rate you secure. Let's think of the world of home loans not as a confusing maze of paperwork, but as a team of superheroes. Each one has a unique power, a specific purpose, and is designed to help a different kind of person achieve the dream of homeownership. Your job isn't to become an expert in all of them, but to find the one hero whose powers are the perfect match for your financial situation. First up, we have the team captain, the most well-known hero of them all: the conventional loan. This is the Superman of the mortgage world. It's strong, reliable, and what most people think of when they hear the word mortgage. A conventional loan is not insured or guaranteed by the federal government. It's a straight-up agreement between you and a private lender, like a bank or a credit union. Because the government isn't co-signing for you, the lender is taking on all the risk. And because they're taking on the risk, they're going to be a little pickier about who they partner with. To get the best terms on a conventional loan, you generally need a good to excellent credit score. Think 620 at the bare minimum, but ideally north of 740 to unlock the best interest rates. You'll also need a solid, verifiable income and a relatively low debt-to-income ratio. The lender wants to see that you're a responsible borrower who has a history of paying bills on time and isn't overextended with other debts like car payments and credit card balances. Now let's talk about the big one, the down payment. You've probably heard the magic number: 20%. Put down 20% and you can avoid something called private mortgage insurance, or PMI. PMI is basically an insurance policy that you pay for, but it protects the lender, not you. Protects them in case you default on the loan. If you put down less than 20%, the lender sees you as a slightly higher risk, so they require you to pay this extra PMI fee every single month, on top of your principal and interest. It can add hundreds of dollars to your monthly payment. The good news? On a conventional loan, once you've paid down your mortgage enough to have 20% equity in your home, you can request to have that PMI removed. It doesn't stick around forever. And here's a secret most people don't know. You don't have to put down 20% to get a conventional loan. Some programs allow for as little as 3% down. But remember the trade-off. A lower down payment means you'll be paying that pesky PMI for a while. So the conventional loan is fantastic for borrowers with strong credit, stable income, and a decent amount of savings for a down payment. It's the gold standard. But what if you're not quite there yet? What if your credit has a few bumps, or you haven't had 15 years to save up a massive down payment? That's when you call in the next hero on the team. Meet the FHA loan. Think of the FHA loan as Batman. It doesn't have the natural superpowers of Superman, but it uses incredible gadgets and support to help people who might otherwise be overlooked. FHA stands for the Federal Housing Administration, and they are the ones providing the gadget, a government guarantee. An FHA loan is insured by the government. This tells the lender, hey, if this borrower defaults, we've got your back. This insurance makes lenders feel a lot more comfortable loaning money to people with less than perfect financial profiles. The FHA loan signature move is its incredibly low down payment requirement, just 3.5%. That's a game changer for so many first-time homebuyers. It can literally be the difference between buying a home this year or waiting another 5 years to save. FHA loans are also much more forgiving when it comes to credit scores. You can often get approved with a score as low as 580, and sometimes even lower depending on the lender and other factors. But as with any hero, there's a weakness, a kryptonite. For the FHA loan, it's called MIP, or mortgage insurance premium. Sounds a lot like PMI, but it's a bit more persistent. With an FHA loan, you pay this insurance premium in 2 ways. An upfront premium that's usually rolled into your total loan amount, and a monthly premium that's part of your house payment. And here's the critical difference. If you put down less than 10%, that monthly MIP payment is there for the entire life of the loan. It never goes away unless you sell the house or refinance into a different type of loan like a conventional one. That's the trade-off. You get into the house with less money down and a lower credit score, but you pay for that privilege over the long haul with mortgage insurance that never disappears. Next, we have a true American hero, the VA loan. This isn't just a loan program, it's a benefit, a thank you, earned through incredible sacrifice. VA loans are available exclusively to active duty service members, veterans, and eligible surviving spouses. This is Captain America. It represents the best of us and provides a benefit that is almost unbelievably good. The VA loan is guaranteed by the U.S. Department of Veterans Affairs, and its powers are legendary. Power number 1, and it's a big one, 0 down payment. That's right. For most eligible veterans, you can buy a home with absolutely nothing down. This is an incredible advantage that removes the single biggest barrier to homeownership for millions. Power number 2, no monthly mortgage insurance. Remember PMI and MIP, those pesky extra fees on conventional and FHA loans? With a VA loan, they don't exist. This can save you hundreds of dollars every single month, and thousands upon thousands over the life of the loan. The VA guarantee gives lenders all the protection they need, so there's no reason to charge you for extra insurance. The VA loan program also has some of the most competitive interest rates on the market and flexible credit requirements. So what's the catch? There really isn't a major one. There is something called a VA funding fee, which is a one-time fee paid to the VA to help keep the program running for future generations. The fee varies depending on your service, your down payment amount, and whether it's your first time using the benefit. But for many, this fee can be rolled right into the loan amount so you don't have to pay it out of pocket. For what you get in return, 0 down, no PMI, it is an absolutely phenomenal deal. Now let's head out of the city and into the countryside to meet our next specialist, the USDA loan. Think of this loan as the green arrow, a hero with a very specific domain and a mission to help a particular community. USDA stands for the U.S. Department of Agriculture, and their goal is to promote homeownership and development in rural, and surprisingly, many suburban areas. The USDA loan has 2 superpowers that rival even the VA loan: 0 down payment required, and reduced mortgage insurance costs compared to FHA or conventional loans. It's designed to make buying a home incredibly affordable for those who want to live outside of major metropolitan centers. You might be shocked to find out what qualifies as rural. Many small towns and suburbs just outside of major city limits are eligible for USDA financing. You can check a property's eligibility right on the USDA website. The limitations, however, are just as specific as its benefits. First, the geographic restriction. The property must be in a designated eligible area. Second, there are income limits. The USDA program is designed for low to moderate income households, so your total household income can't exceed a certain amount for that area. But if you meet the location and income requirements, the USDA loan is one of the most powerful and affordable paths to homeownership that exists. Finally, for the grand finale, we have the heavy hitter, the Hulk of the loan world, the jumbo loan. This loan is for when you're buying a property that is, well, jumbo. In most parts of the country, there's a limit on the amount of money you can borrow for a conventional loan. This is called the conforming loan limit, and it's set by federal regulators. As of right now, it's over $760,000 in most counties, but it can be over $1 million in high-cost areas like parts of California and New York. If you need to borrow more than that limit to buy your dream mansion or a high-end city condo, you're entering jumbo territory. Because these loans are for such large amounts, and they aren't backed by government agencies, the risk to the lender is massive. So, to qualify for a jumbo loan, you need to be a financial heavyweight yourself. We're talking about stellar credit scores, often 760 or higher. You'll need a significant down payment, usually at least 20 to 30%. And lenders will want to see substantial cash reserves, enough to cover your mortgage payments for a year or more, even after you've paid your down payment and closing costs. A jumbo loan is the high-stakes, high-reward option for luxury real estate. So there you have it. The starting lineup: conventional, FHA, VA, USDA, and jumbo. Each one a powerful tool. A unique hero ready to help a specific type of buyer. Choosing the right one is like picking the right character for the mission. But picking your hero is only the first half of the battle. Once you know which type of loan you're getting, you have to decide on its fundamental structure. Will it be predictable and steady for the next 30 years? Or will it be flexible with a lower rate now but the risk of change later? We're talking about the epic showdown between fixed rates and adjustable rates. And that decision will dictate your financial life for decades to come. So let's settle this once and for all. On one side of the ring, you have the heavyweight champion of predictability, the titan of stability, the fixed-rate mortgage. And on the other, the nimble, adaptable challenger, a high-risk, high-reward contender, the adjustable-rate mortgage, or ARM. First, let's talk about the rock. The fixed-rate mortgage is exactly what it sounds like. You agree on an interest rate with your lender. Let's say it's 6.5%, and that rate is locked in. It is set in stone for the entire life of your loan, whether that's 15 years, 30 years, or some other term. Your monthly payment for principal and interest will be the exact same number on your very first payment as it is on your very last. It will never change. Not if the economy soars, not if it crashes, not if inflation goes to the moon. Nothing. Think of it like this. It's the ultimate subscription service with a lifetime price lock. Imagine signing up for your favorite streaming service in 2010 for $10 a month, and the company promises you will pay $10 a month forever. While everyone else is complaining about prices going up to $15, then $20, then $25, you're still paying your $10. That is the power and the profound peace of mind of a fixed-rate mortgage. The primary benefit, its superpower, is predictability. You know exactly what your largest monthly expense will be for the next 3 decades. This makes budgeting, financial planning, and just plain sleeping at night incredibly easy. There are no surprises, no nail-biting anxiety watching the financial news. You are insulated from the turbulent world of interest rate fluctuations. If rates across the country were to double next year, it wouldn't affect your payment by a single penny. You just sit back, sip your coffee, and feel like a financial genius for locking in when you did. But this ironclad security comes at a price. The trade-off for the lender taking on all that risk, the risk that rates will rise and they'll be stuck with your low-rate loan, is that they typically charge a slightly higher interest rate from the start compared to an ARM. You're paying a small premium for that guarantee of stability. Furthermore, if interest rates plummet after you've locked in, you're stuck with your higher rate. Your only escape is to refinance, which is a whole new loan application process with its own set of closing costs. You can't just call up the bank and ask for the new lower rate. So, who is the fixed-rate mortgage for? It's the gold standard for most American homeowners, especially first-time buyers. It's for the family that plans on putting down roots, raising kids, and staying in their home for the long haul. It's for the pre-retiree who needs a predictable housing expense on a fixed income. It's for anyone who is fundamentally risk-averse and values a good night's sleep over the potential to save a few bucks. It is the set-it-and-forget-it option. Now let's turn to the other contender, the chameleon of the mortgage world, the adjustable-rate mortgage. An ARM is a completely different animal. It's a hybrid. It starts with an introductory period where the interest rate is fixed, typically for 3, 5, 7, or 10 years. And during this period, the rate is almost always lower than what you could get on a 30-year fixed mortgage at the same time. This is the bait. This is the allure. A lower rate means a lower monthly payment, which could help you afford more house, or just have more cash in your pocket each month. But after that introductory period ends, the adjustable part kicks in. Your interest rate is no longer fixed. Instead, it will change or reset, periodically, usually once every year. And how does it change? It's tied to a broader financial market index, a benchmark that goes up and down with the economy. The lender then adds their preset profit margin on top of that index to determine your new interest rate. When you see an ARM advertised as a 5-1 or 7-1 ARM, that's what it means. A 5-to-1 ARM has a fixed rate for the first 5 years, and then it adjusts once every 1 year after that. A 7-to-1 ARM is fixed for 7 years, then adjusts annually. The massive, flashing red light risk of an ARM is uncertainty. If interest rates in the wider economy have gone up since you got your loan, your rate will go up. And when your rate goes up, your monthly payment goes up. Sometimes it can go up by a lot. This payment shock is what got millions of people into trouble during the 2008 housing crisis. They were lured in by a low initial payment, but when their rates reset to a much higher level, their payments ballooned to unaffordable amounts. However, ARMs are not inherently evil. They are tools, and when used correctly, they can be incredibly powerful. The biggest pro is that lower initial payment. For someone who knows for a fact they will not be in the home long term, an ARM can be a brilliant financial strategy. Let's say you're a medical resident, and you know you'll be moving in 4 years for a new job. Why would you pay the premium for a 30-year fixed-rate stability? You could get a 5-to-1 ARM, enjoy a significantly lower payment for the 4 years you live there, and then sell the house long before the first rate adjustment ever happens. You've essentially pocketed the savings. Another potential benefit is that if rates go down, your payment could also go down after the adjustment period. Unlike a fixed-rate mortgage holder who has to pay to refinance, your rate will automatically adjust downward with the market. To protect borrowers from catastrophic increases, ARMs come with safety features called caps. These are crucial. There's usually an initial adjustment cap, which limits how much the rate can jump the very first time it adjusts. Then there's a periodic cap, limiting how much it can increase in any subsequent adjustment period. And most importantly, there's a lifetime cap, which sets a ceiling on how high your interest rate can ever go, no matter what happens in the market. You absolutely must understand these caps before signing on for an ARM. They are your only parachute. So how do you choose? It's not about which loan is better. It's about which life you're planning to live. It comes down to a simple question. Are you playing the long game or the short game? Look at Sarah and Tom. They found their dream home in a great school district. They plan to watch their kids grow up there, celebrate graduations, and maybe even host weddings in the backyard 25 years from now. For them, the long-term stability of a fixed-rate mortgage isn't just a feature. It's a necessity. The peace of mind is worth the slightly higher initial rate. Now look at Alex. He's a young software engineer who just took a job in a new city. He's ambitious and fully expects his career to take him somewhere else in the next 5 to 7 years. For Alex, a 7-to-1 ARM makes perfect sense. He can take advantage of the lower monthly payment, allowing him to invest more aggressively or just enjoy his new city. He'll sell the property and move on long before the risk of a rate adjustment becomes a reality. The economic environment also plays a huge role. When interest rates are at historic lows, most people will rush to lock in that low rate for 30 years. It's a no-brainer. But when rates are high, an ARM can look much more attractive. You can get a lower initial rate and bet that by the time your adjustment period comes up in 5 or 7 years, the overall rates in the economy will have cooled off, and your loan will adjust to a more favorable number. So you've chosen your weapon: the unshakable shield of a fixed rate, or the agile sword of an ARM. But the battle isn't over. Now you have to decide how long the war will last. Are you signing up for a 30-year marathon, or a 15-year sprint? The difference isn't just 15 years of payments. It's potentially hundreds of thousands of dollars. And that's what we're breaking down next. The 30-year marathon or the 15-year sprint. This single choice is arguably more important than the paint colors, the kitchen countertops, or even the school district. Because this choice right here determines the true cost of your home. Not the sticker price, but the price you will actually pay over time to the bank for the privilege of borrowing their money. Let's put some real numbers to this, because that's when the fog lifts and the battlefield becomes crystal clear. Imagine a home loan of $400,000. That's our principal. Let's say the interest rate is 6.5%. Pretty standard stuff. Now you stand at a fork in the road. Path A is the 30-year mortgage. Path B is the 15-year. Let's walk down path A first. The 30-year mortgage. The bank tells you your monthly payment, principal and interest, will be about $2,528. Okay, manageable. You can budget for that. You can still afford a car payment, maybe a vacation. Feels comfortable. Feels safe. This is why nearly 90% of American homebuyers choose this path. It is the American standard. It's the path of least resistance. You sign on the dotted line, and for the next 360 months you send the bank that check. Now let's do the math the bank hopes you don't focus on too much. You make that payment every single month for 30 years. At the end of that marathon, you will have paid the bank a grand total of over $910,000. Let me say that again. For a $400,000 loan, you have paid back more than $900,000. Over $500,000, $510,000 to be exact, was pure interest. It was the bank's profit. It was the cost of comfort. You paid more in interest than you did for the actual house. Now let's go back to that fork in the road and choose path B, the 15-year sprint. The bank runs the numbers. They tell you your monthly payment will be $3,480. And right there your stomach tightens. That's almost $1,000 more per month. That's a car payment. That's the entire vacation budget. That hurts. Feels restrictive. Feels like a sacrifice. And it is. This is the path of financial discipline. It's not for everyone. But you decide to do it. You tighten the belt, you commit, and for the next 180 months you send that bigger check. Now let's do that math. At the end of your 15-year sprint, you are completely debt-free. You own your home outright. You have paid the bank a total of about $626,000. Your total interest paid? Around $226,000. Let's put those two outcomes side by side. By choosing the 15-year path, you paid $284,000 less. $284,000. That is a brand new Ferrari. That is a college education for 2 kids. That is a significant chunk of your retirement. It is a life-changing amount of money that you either keep in your pocket or you hand over to the bank, simply based on which box you checked at closing. But the difference is even more profound than just the final number. We need to talk about the hidden enemy in this war, amortization. Amortization is how the bank structures your payments to make sure they get their money first. On a 30-year mortgage, your early payments are almost entirely interest. That $2,500 check you're so proud of sending in month after month? For the first few years, maybe only $500 or $600 of that is actually reducing your $400,000 loan. The other $2,000 is just profit for the bank. You are running on a financial treadmill. You're sweating, you're putting in the effort, but for the first 5 to 10 years you're barely moving forward. It's a soul-crushing reality. On the 15-year mortgage, that higher payment means you are attacking the principal from day one. A much larger portion of each payment goes directly to chipping away at what you owe. You're not just paying the bank for their time. You're actively buying your freedom month by month. You build equity at a staggering rate. In just a few years, you've paid down more of your loan than a 30-year mortgage holder would in over a decade. This isn't just a numbers game. It's a psychological one. Imagine being 45 years old. The person who took the 30-year loan is still staring down another 15 years of payments. They're only halfway through the marathon. They'll be paying that mortgage when they're 60. But you? You're done. The race is over. You won. That $3,480 a month is now yours. You can pour it into retirement. You can travel the world. You have a level of financial freedom your neighbor won't taste for another decade and a half. The weight of that debt is gone. Now, a savvy investor might be thinking, wait a minute, what about opportunity cost? And that is the one single powerful argument for the 30-year mortgage. The theory goes like this. Take the 30-year loan with the lower payment. Then, take that extra $950 a month that you would have paid on the 15-year and invest it. If your mortgage rate is 6.5%, and you can earn, say, 9 or 10% in the stock market over the long run, you'll come out ahead. You're using the bank's cheap money to make more money elsewhere. In a perfect world on a spreadsheet, this strategy is flawless. It works. But we don't live on a spreadsheet. We live in the real world, where this strategy requires the discipline of a Navy SEAL. It requires that for 360 consecutive months, you never fail to invest that extra money. You don't use it for a new car. You don't let it get absorbed into your lifestyle when you get a raise. You don't panic and sell when the market dips. Paying extra on your mortgage, especially a 15-year mortgage, is a guaranteed 6.5% return on your money. It's risk-free. Investing in the market is not. So the choice becomes a bet. Are you betting on the stock market, and more importantly, are you betting on your own unwavering 30-year discipline? Or are you taking the guaranteed win? For most people, the guaranteed win is the smarter choice. But it doesn't have to be a brutal, all-or-nothing decision. There is a third way, a hybrid strategy. You can take out the 30-year mortgage, securing that lower required monthly payment as a safety net. But then, you voluntarily make extra payments each month, paying it as if it were a 15-year loan. You use a mortgage calculator, figure out what the 15-year payment would be, and you pay that amount. This gives you the best of both worlds. You're on track to pay off your house in 15 years and save a fortune in interest, but if you have a bad month, you lose your job, have a medical emergency, you have the flexibility to fall back to the lower required payment without penalty. It's a strategy that combines ambition with the parachute. So you've chosen your timeline: the marathon, the sprint, or the flexible hybrid. You understand the stakes. You understand the cost of time. You've made the biggest financial decision of the entire process. You feel secure. But what if the battlefield could shift under your feet? What if that 6.5% interest rate, the very foundation of all these calculations, wasn't set in stone? What if the bank could change the rules of the game 5 years into your loan? That's the terrifying and sometimes tempting reality of the adjustable rate mortgage. And that's exactly where we're going next. Imagine a world where your stable, predictable monthly payment, the one you painstakingly budgeted for using all those calculations, wasn't set in stone. What if the bank could change the rules of the game 5 years into your loan? That's the terrifying and sometimes tempting reality of the adjustable rate mortgage. And that's exactly where we're going next. The adjustable rate mortgage, or ARM, is the wild card of the home loan world. While the fixed rate mortgage is like a sturdy, reliable oak tree, weathering every economic season without changing, the ARM is a financial chameleon, changing its colors based on the economic environment around it. It's a loan where the interest rate you pay is not locked in for the entire term. Instead, it can go up or down over time. So why on earth would anyone sign up for that kind of uncertainty? The answer is simple and deeply seductive: the teaser rate. Lenders lure you in with an ARM by offering an initial interest rate that is significantly lower than the going rate for a 30-year fixed mortgage. It's a beautiful, tantalizingly low number. For the first few years, your monthly payment is wonderfully, almost artificially affordable. You feel like you've cracked the code. You're paying less than your friends who got that safe fixed-rate loan. You're saving hundreds of dollars a month. Money you can put towards furniture, renovations, or investments. It feels like a brilliant financial move. But it's called a teaser for a reason. It's the introductory price. And like any introductory price, it's designed to end. To understand the ticking clock inside an ARM, you have to understand its 3 core components: the index, the margin, and the adjustment period. First, the index. Think of the index as a public benchmark for interest rates, a sort of financial weather report. It's a rate that the lender doesn't control. A common one you'll see is the SOFR, or the Secured Overnight Financing Rate. When you hear on the news that interest rates are rising, it's benchmarks like this that are on the move. Your ARM's rate is directly tied to this public index. If the index goes up, your rate goes up. If it goes down, your rate goes down. Second, the margin. This is the part the lender does control. The margin is a fixed percentage that the lender adds on top of the index. This is their profit. So the formula for your interest rate is simple. Index rate plus lender's margin equals your interest rate. The margin never changes for the life of your loan. If your margin is 2.5%, it will always be 2.5%. It's the index that fluctuates. Finally, and most critically, the adjustment period. This is where the numbers on the loan's name, like a 5-to-1 ARM or a 7-to-1 ARM, come into play. These aren't random numbers. They are the blueprint for your loan's future. In a 5-to-1 ARM, the first number, 5, tells you how many years your initial, low teaser rate is locked in. For 5 glorious years, your payment is fixed and predictable. The second number, 1, tells you how often the rate will adjust after that initial period is over. In this case, it will adjust once every 1 year. So, for a 5-to-1 ARM, you get 5 years of stability, followed by 25 years of annual rate adjustments. A 7-to-1 ARM gives you 7 fixed years, then adjusts annually. A 10-to-1 ARM, 10 years. Let's make this real. Let's tell a tale of 2 homeowners, Sarah and Mike. They buy identical houses side by side for $400,000. Sarah's cautious. She chooses a 30-year fixed-rate mortgage at 6%. Her principal and interest payment is locked in at about $2,398 per month. It will be $2,398 today, and it will be $2,398 in 20 years. She can budget her entire life around this number. It's predictable. It's safe. Mike sees an opportunity. He's offered a 5-to-1 ARM with a teaser rate of just 4%. His initial monthly payment is only $1,910. He is saving nearly $500 a month compared to Sarah. For the first 5 years, Mike feels like a genius. He's invested that extra $30,000 he saved. He takes nicer vacations. He tells everyone about the sucker's bet of a fixed-rate loan. Then year 6 arrives. The 5-year fixed period on Mike's arm is over. It's time for the first adjustment. During those 5 years, the economy has changed. The index his loan is tied to has risen from 2% to 5%. His lender's margin is 2.5%. So his new interest rate is the index 5%, plus the margin 2.5%, which equals 7.5%. Overnight, Mike's interest rate jumps from 4% to 7.5%. His monthly payment explodes from $1,910 to over $2,650. This is the infamous payment shock. He's now paying $250 more per month than Sarah, his cautious neighbor. The financial advantage he enjoyed for 5 years has not only vanished, it has reversed into a massive liability. He's in a panic. The extra money he was investing now has to be rerouted just to cover his mortgage, and it's not even enough. Now you might be thinking, isn't there any protection? Can the rate just shoot to the moon? And the answer is yes, there are protections. They're called caps. But they might not be the safety net you think they are. There are usually 3 types of caps on an arm. An initial adjustment cap limits how much the rate can increase on that very first adjustment. A periodic cap limits how much it can increase in any subsequent adjustment period. And a lifetime cap sets the absolute maximum interest rate you could ever be charged over the life of the loan. Let's go back to Mike. Maybe his loan had a 2/2/5 cap structure. The first 2 means his initial rate adjustment can't be more than 2 percentage points. The second 2 means subsequent annual adjustments can't be more than 2 points. And the 5 means the rate can never increase by more than 5 percentage points above his initial 4% rate. This is his lifetime cap, meaning his rate can never, ever go above 9%. So in year 6, his rate only jumps from 4% to 6% because of that initial 2% cap. Even though the market rate is 7.5%. His payment is now around $2,250. It's a huge jump, but it's manageable. He breathes a sigh of relief. But in year 7, the index is still high. His rate can adjust again up to another 2%. It jumps from 6% to 8%. Now his payment is nearly $2,800. The caps didn't prevent the pain. They just delayed it and spread it out. And he still lives with the fear that his rate could one day hit that 9% lifetime cap, pushing his payment to over $3,000 a month. A soul-crushing number he never imagined when he signed up for that low 4% rate. So who are these loans for? Are they just traps? Not necessarily. They are highly specialized tools for specific situations. An ARM can make sense for someone who knows with near certainty that they will sell the home before the fixed rate period ends. If you have a 5-year work assignment in a new city and plan to sell in year 4, a 5-to-1 ARM lets you enjoy a lower payment for the entire time you own the home. It can also work for a high-income earner who can already afford the payment at the fully indexed rate, but uses the teaser rate to save cash for a few years. The key is they aren't surprised by the payment shock because they were prepared for it from day one. But for most people, an ARM is a gamble. It's a bet that interest rates will be lower when your adjustment period begins. And as anyone watching the economy in recent years can tell you, that is a dangerous, unpredictable bet to make. This very mechanism, the teaser rate, the payment shock, the hope of refinancing before the adjustment, was a primary villain in the 2008 financial crisis. Millions of American families were sold on the dream of a low monthly payment, only to have that dream turn into a nightmare when their rates reset to a level they could never hope to afford. Ultimately, the choice between a fixed rate and an adjustable rate mortgage is a choice between certainty and risk. A fixed rate mortgage is a 30-year promise of stability. An ARM is a short-term discount with a long-term question mark attached. But whether your rate is fixed or adjustable, the interest you pay is only part of the story. There's another monthly cost, a silent partner in your payment that has nothing to do with the bank's profit or market indexes. It's the money you have to pay for the privilege of owning your property and protecting it from disaster. I'm talking about taxes and insurance, bundled together in a mysterious little package called escrow, an untangling that is our next mission. So let's get into it. Think of your lender not just as a bank but as your very nervous business partner. They just fronted you hundreds of thousands of dollars to buy an asset, your house, and they have a vested interest in making sure that asset doesn't, well, disappear. What are the 2 biggest threats to that house that aren't you? First, the government. If you don't pay your property taxes, the local county or municipality can put a lien on your home, and in a worst-case scenario, foreclose and sell it to get their money back. Poof! The bank's investment is gone. The second threat? Catastrophe: a fire, a hurricane, a massive hailstorm. If your house is destroyed and you don't have insurance, the bank is left holding a loan for a pile of rubble. Poof! Their investment is gone again. So the lender, in a moment of brilliant self-preservation, came up with a solution: the escrow account. It's not your account and it's not really their account. It's a protected third-party holding pen for money. It's like a financial bodyguard for your home. Your lender says, look, instead of you remembering to save up and pay these 2 massive house-threatening bills every year, we're going to make it simple. We'll take a little bit of money for taxes and a little bit for insurance from you each month, along with your mortgage payment. We'll put that money in the escrow account, and when the bills come due, we'll pay them for you. On time. Every time. This is where that famous acronym PITI comes into play. PITI. It's the 4-letter word that defines your true monthly housing cost. We've already obsessed over the P and the I, the principal and interest that go towards paying back your loan. But the T and the I are what escrow is all about. Let's start with the T: taxes. Property taxes are the lifeblood of your local community. They pay for public schools, road repairs, the fire department that shows up if things go wrong, the police department, libraries, and parks. You're not just buying a house. You're buying into a community and paying your dues. These taxes are set by your local government and are based on the assessed value of your property. This is key. The assessed value isn't necessarily what you paid for the house. It's what the local tax assessor says it's worth, and they recalculate this periodically. So if your home's value shoots up, guess what? Your property taxes are likely going up too. This is a bill that can change, and it's often thousands or even tens of thousands of dollars per year, usually due in 1 or 2 lump sums. Forgetting to pay it is not an option. Next is the I: insurance. Homeowner's insurance. This is your personal financial shield. It protects you from the what ifs. What if a tree falls on your roof? What if a pipe bursts and floods your kitchen? What if someone slips on your icy driveway and decides to sue you? Homeowner's insurance covers the cost of repairs, rebuilding, and even liability. Your lender requires you to have it. It's non-negotiable. They need to know that if the worst happens, their investment can be rebuilt. You get to choose your insurance provider and your coverage level, but you must have a policy in place. So, how does the lender figure out your monthly escrow payment? It's simple yet slightly imperfect math. They'll get an estimate of your annual property tax bill and your annual homeowner's insurance premium. Let's say your property taxes are projected to be $4,800 for the year, and your homeowner's insurance is $1,200 for the year. That's a total of $6,000 in non-mortgage expenses. The lender divides that by 12, which comes out to $500 per month. That $500 is your monthly escrow payment. It gets tacked right onto your principal and interest payment. So if your P&I is $1,500, your total PITI payment that you send to the lender each month is $2,000. You pay one bill, and the lender handles the rest. Now here's a detail that trips people up. Your lender is also legally allowed to keep a cushion in your escrow account, typically up to 2 months' worth of payments. In our example, that's an extra $1,000. Why? Because they're not psychic. They know that tax rates can be hiked and insurance premiums can rise unexpectedly. That cushion ensures there's enough cash in the account to cover a surprise increase without the account going negative. This leads to the single most confusing part of escrow for homeowners: the annual escrow analysis. Once a year, your lender will look at your account and do a checkup. They'll compare what they collected from you with what they actually had to pay out. 2 things can happen. First, there could be a shortage. Maybe your property taxes went up by $600 for the year. The lender paid the bill using your cushion, but now the account is low. They have to make up that shortfall and adjust your future payments to account for the new, higher tax bill. This is the dreaded letter homeowners get that says, your monthly payment is going up by $80 next month. It's not the bank raising your interest rate. It's the escrow account recalibrating to reality. You'll usually have the option to pay the shortage in a lump sum, or have it spread out over the next 12 months, which raises your payment even more temporarily. But sometimes the opposite happens. You get an overage. Maybe you switched insurance providers and saved $300 a year, but you were still paying the old higher amount into escrow. At the end of the year, the lender does the analysis and finds there's too much money in the account, even with the cushion. By law, if the overage is over a certain amount, usually $50, they have to send it back to you. This is the best day of the year for a homeowner. Opening the mail and finding an unexpected check from your mortgage company. It feels like a refund, a little bonus for being a responsible homeowner. But wait, there's a potential fifth letter that can sneak into your payment, turning pity into pump. That M stands for mortgage insurance, specifically private mortgage insurance or PMI. If you hear a collective groan from homeowners across America, it's probably because of PMI. PMI is another layer of insurance, but with a cruel twist. You pay for it, but it protects the lender. Doesn't protect you at all. It's the lender's insurance policy against you. It kicks in if you put down less than 20% on a conventional loan. The logic is this. If you only put 5% down, you have very little skin in the game. You have less to lose by walking away if times get tough. Therefore, from the lender's perspective, you represent a higher risk of default. To offset that risk, they require you to pay for an insurance policy that will reimburse them if you stop paying and they have to foreclose. It can add anywhere from $50 to a few $100s to your monthly payment, money that builds you zero equity and provides you zero direct benefit. It feels like a penalty for not being rich enough to have a 20% down payment. But here is the critical multi-thousand-dollar piece of information about PMI. It is not a life sentence. It is designed to be temporary. Once your loan-to-value ratio reaches 80%, meaning you've paid down your mortgage balance to 80% of the home's original purchase price or its current appraised value, you can formally request that your lender cancel the PMI. They have to by law. Even better, by federal law, lenders are required to automatically terminate PMI once your loan balance is scheduled to reach 78% of the original value. This is a moment to circle on your calendar. Getting rid of PMI is like giving yourself an instant raise every single month for the rest of your loan. So, when you look at that monthly payment, you're not just paying for the money you borrowed. You're paying for the principal, the interest, and through escrow, you're paying for your membership in society with taxes and your peace of mind with insurance. And if you're like most first-time buyers, you might also be paying that PMI to cover the lender's risk. This total amount, your pity or PITM, is the number that truly matters. It's the real cost of keeping a roof over your head. You now understand the anatomy of a mortgage payment. You know how the deal is structured and what every dollar is for. But the structure itself, the very DNA of your loan, can be radically different depending on the product you choose. You're standing at a crossroads with two main paths. One is a straight, predictable road that stretches for 30 years. The other is a winding path, with potential shortcuts and hidden cliffs, where the landscape changes with the economic seasons. Do you lock in your fate for better or for worse? Or do you gamble on the future, hoping to win big? That monumental choice between a fixed-rate mortgage and an adjustable-rate mortgage is one of the most consequential financial decisions you will ever make. And it's exactly where we're headed next. So you stand at a crossroads, a defining moment in your financial life. To your left is a path of certainty, a straight, predictable road stretching out for 30 years. To your right, a path that starts smooth and easy, but winds into hills and valleys, its future hidden by the fog of economic change. This isn't just a choice between loan products. It's a choice between two fundamentally different philosophies of risk and security. Let's start with the path of certainty, the fixed-rate mortgage. Think of it as a solemn promise etched in stone. Your lender says, for the next 360 months, your interest rate will be exactly this. It will not change if the economy soars. It will not change if the economy crashes. It will not change if aliens land on the White House lawn. This is your rate. Forever. The principal and interest portion of your monthly payment will be the exact same number on your very first payment as it is on your very last. The only thing that might fluctuate is your property taxes and homeowner's insurance, which are often bundled into your payment through an escrow account. But the core loan itself is a fortress of predictability. This is the sleep well at night mortgage. For the vast majority of American homeowners, this is the default, the gold standard. Why? Because it eliminates the single biggest variable in a long-term loan: interest rate risk. You can budget for the next 10, 20, 30 years knowing precisely what your biggest expense will be. It's a powerful feeling of control in a world that often feels chaotic. If you buy a home and lock in a 4% interest rate, and a few years later the national average soars to 8%, you can sit back with a quiet sense of victory. You beat the market. You are insulated from the storm raging outside. Your financial foundation is secure. But what's the catch? Well, security has a price. Lenders aren't just being nice. They are pricing in the risk that rates could go up. So, the initial interest rate on a fixed-rate mortgage is often slightly higher than the starting rate on its riskier cousin. And what if the opposite happens? What if you lock in at 7%, and 2 years later the economy shifts and rates plummet to 4%. You're stuck. You're paying thousands more in interest every year than new buyers are. Your only escape is to refinance, which is essentially taking out a whole new loan to pay off the old one, and that comes with its own set of closing costs and qualifications. The fortress that protected you from rising rates has now become a prison, locking you out of lower ones. Now let's look at the other path, the winding road of the adjustable rate mortgage, or ARM. The ARM is a chameleon. It starts its life looking incredibly attractive, often masquerading as a better deal than the fixed rate. It lures you in with a low introductory teaser rate. This is what you see in names like a 5-1 ARM or a 7-1 ARM. The first number tells you how many years that beautiful, low introductory rate is locked in. For a 5-1 ARM, you get 5 years of fixed-rate bliss. Your payment is predictable, and it's probably lower than what your friend with the fixed-rate mortgage is paying. You feel smart. You're saving money every single month. But then the adjustment happens. That second number, the 1 in 5-1, tells you how often the rate will change after the initial period is over. In this case, it will adjust once every 1 year. And this is where the fog of the future begins to clear, for better or for worse. Your new interest rate isn't chosen at random. It's calculated using two key components: the index and the margin. The index is a benchmark interest rate that reflects general market conditions, like the SOFR, the Secured Overnight Financing Rate. It goes up and down with the economy. The margin is a fixed number of percentage points that the lender adds to the index. The margin never changes. So, if the index is at 5% and your margin is 2%, your new interest rate is 7%. If the index falls to 3% next year, your rate becomes 5%. This is the gamble of the ARM. You are betting that when your adjustment period hits, interest rates in the general economy will be the same, or even lower than when you started. If you win that bet, you could end up paying far less over the life of the loan than you would have with a fixed-rate mortgage. But if you lose, you face what's known in the industry as payment shock. Imagine your rate jumping from a comfortable 3.5% to a staggering 7.5%. Your monthly payment could suddenly swell by hundreds, even over $1,000. It's a budget-breaking scenario that has, historically, been a primary driver of foreclosures. To prevent utter catastrophe, ARMs have safeguards called caps. These limit how much your interest rate can change. You'll typically see a series of 3 numbers like 2/2/5. The first number is the initial adjustment cap. It means that the very first time your rate changes, it can't go up by more than 2 percentage points. The second number is the subsequent adjustment cap. For every adjustment after that, it also can't go up by more than 2 percentage points per period. The third number is the lifetime cap. No matter what happens in the world, your interest rate can never increase by more than 5 percentage points over your initial starting rate. These caps are a safety net, but as you can see, they still allow for dramatic and painful increases in your payment. So who on earth would take this risk? The ARM isn't for everyone, but it can be a brilliant strategic tool for the right person in the right situation. Are you buying a starter home that you know for a fact you will sell in 4 years, well before your 5-1 ARM ever adjusts? If so, you could save thousands by taking advantage of the lower initial rate. Are you a high-income earner, perhaps with a fluctuating commission-based salary, who has the cash flow to easily absorb a potential payment increase? The ARM might make sense. Or are you buying a home during a period of historically high interest rates? You might take an ARM with the explicit strategy of riding out the low introductory rate for a few years, with the full intention of refinancing into a lower fixed-rate loan once the market cools down. The choice is a reflection of your life, your finances, and your tolerance for risk. The fixed-rate mortgage is for the planner, the long hauler, the person who values peace of mind above all else. It's for the family putting down roots, who wants their housing cost to be the one thing they never, ever have to worry about. The adjustable rate mortgage is for the strategist, the short-timer, the financial risk-taker who is willing to trade long-term security for short-term advantage. It's a calculated risk, a bet on your own future plans and the direction of the economy. You've now navigated the complex world of government backing, from FHA to VA. You've weighed the merits of a 15-year sprint versus a 30-year marathon. And now, you've stared down the two great philosophical paths of lending, the stability of the fixed rate versus the potential of the ARM. You've chosen your loan program, your term, and your rate structure. You've found the perfect house. The pre-approval is in hand. Feels like you've crossed the finish line. But this is the most deceptive moment in the entire home buying journey, because the gauntlet of paperwork, the hidden fees, and the last-minute traps that lie between you and the keys to your new home are the most dangerous part of the entire process. And navigating that final minefield, the closing, is where dreams are either realized or shattered. The closing process is the final 10 yards of a 100-yard dash, but it's covered in broken glass and tripwires. It's where lenders can slip in last-minute changes, where unexpected fees can materialize out of thin air, and where a single unchecked box can cost you thousands of dollars over the life of your loan. This is where the abstract numbers on a piece of paper become a legally binding reality. Your most powerful weapon in this final battle is a document called the Closing Disclosure, or CD. By federal law, you must receive this document at least 3 business days before you are scheduled to close. This isn't a suggestion, it's your right. This 3-day review period is a mandatory cooling-off period, designed to stop lenders from ambushing you at the closing table with a worse deal than you agreed to. They used to be able to do that. They can't anymore, but only if you use this time wisely. When you get that closing disclosure, your mission is simple but critical. Compare it line by line to the loan estimate you received at the very beginning of this process. They should look almost identical. If they don't, you need to raise hell immediately. First, check the big 3, the loan amount, the interest rate, and the monthly principal and interest payment. These should be exactly what you expected. If that interest rate has mysteriously ticked up by 1/8 of a point, that's not a typo, that's a red flag. Next, you dive into the closing costs. This is where the real trickery can hide. You'll see a section called Loan Costs. This includes origination fees, which is what the lender charges for creating the loan, application fees, and underwriting fees. These are the lender's direct profit centers. Then you'll see services you cannot shop for, like the appraisal fee and the credit report fee, and services you can shop for, like the title search, lender's title insurance, and pest inspection. But here's the thing. Even if you can shop for them, many first-time buyers don't. They just go with the lender's recommendation, which might not be the cheapest. Look at these numbers. Do they seem reasonable? Did they suddenly inflate from what was on your loan estimate? Then you'll see the truly confusing part for most people. Prepaids and escrows. You'll be asked to prepay the interest on your loan from the day you close to the end of the month. You'll also be asked to fund your escrow account. An escrow account is like a separate savings account managed by your lender. Every month, part of your total payment goes into this account, and the lender uses that money to pay your property taxes and your homeowner's insurance on your behalf. At closing, they need you to put a cushion of several months' worth of these payments into the account to get it started. This can add thousands of dollars to the amount you need to bring to the table. And that brings us to the final, most important number on the entire closing disclosure: the cash to close. This is it. This is the exact dollar amount you need to have wired for the closing. It's your down payment plus all those closing costs minus any credits you're receiving, like your earnest money deposit or any seller concessions. If this number is wildly different from what you were expecting, you stop everything and you call your loan officer. You do not proceed until you understand every single cent. And it is here, in this final high-stakes moment, that the true difference between a home loan and a mortgage finally becomes crystal clear. It's the distinction that this entire journey has been leading up to. All this time you've been working on your home loan. The home loan was the deal. It was the agreement. It was the promise from a lender to give you a certain amount of money at a certain interest rate. The application, the pre-approval, the loan estimate, the underwriting, that was all part of the process of securing the loan. The loan is the financial product. The mortgage, on the other hand, is what you sign at the closing table. The mortgage is the legal instrument. It is a security document that ties your property to the loan. Think of it this way: the home loan is the promise you make to pay back the money. The mortgage is the legal consequence if you break that promise. It's the document that gives the lender the right to foreclose on your house and take possession of it if you fail to pay. The home loan is the agreement. The mortgage is the collateral. The home loan is the handshake. The mortgage is the chain that binds the house to that handshake. In some states, this security instrument isn't called a mortgage. It's called a deed of trust. Functionally, for you as a homeowner, they accomplish the same thing. They secure the lender's investment using your home. But they are legally distinct, and it's critical to understand that you are signing two separate, profoundly important documents at closing. First, you sign the promissory note. This is your IOU to the lender. It details the loan amount, the interest rate, the dates payments are due, and where they are to be sent. This is your personal promise to repay the loan. Second, you sign the mortgage or deed of trust. This document gets publicly recorded in your county's records. It creates a lien against your property. This is what makes your home the security for the promissory note. You can't sell the house without paying off the note, because the mortgage creates a cloud on the title that must be cleared. So when you're sitting at that closing table, surrounded by a mountain of paperwork, you are finalizing your home loan by signing the promissory note, and you are securing that loan by signing the mortgage. That is the fundamental difference. One is the debt, the other is the security for the debt. After you've signed your name so many times your hand feels like it's going to fall off, after the funds have been wired and confirmed, the closing agent will look up, smile, and slide a set of keys across the table. In that moment, the entire grueling process, the credit pulls, the document hunts, the underwriting anxiety, the closing disclosure review, it all fades away. You are no longer just a borrower. You are a homeowner. We've journeyed from the simple dream of owning a home, through the labyrinth of pre-approvals and underwriting, to the final critical moments at the closing table. You now know that a home loan is the broad financial arrangement, while a mortgage is the specific legal tool that uses your home as collateral. Understanding this isn't just about semantics, it's about understanding the power you are giving your lender. It's about respecting the commitment you are making. The American dream of homeownership is a beautiful thing, but it's built on a foundation of complex, often confusing financial and legal structures. By understanding these structures, you take control. You transform yourself from a hopeful applicant into an informed consumer, capable of navigating the process with confidence. The knowledge you've gained isn't just a shield against bad deals. It's the blueprint for building a secure financial future. The house is the dream, but knowledge is the key that truly unlocks the door. Use that key wisely,